Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas chief economist Don Rissmiller to talk all things economy. Don, how are you doing today?
Very good, Russ. Good to talk with you.
Great to have you, and very timely as well. We are recording on a Thursday morning, just after a fresh CPI report for July. So inflation seemed to come in about in line with expectations, but I want to turn it over to you. What's your big takeaway from the report? And maybe secondarily, what does it mean for the Fed, who doesn't have another meeting until September, but has indicated that they may hike at that meeting?
That's right. And so we'll have another report on inflation and some additional data on employment before we get to the Fed meeting. But if we just take today's number at face value, it's an inline report and it's a good report. We now have several months in a row where we're seeing slower inflation and we're seeing slower core inflation. So this is a good report, not to take anything away from this. And this really follows the pattern over the past several years where we've seen a very symmetric rise and fall in inflation. And that's historically normal. When inflation rises quickly, it tends to fall quickly. There's a symmetry there that has worked again this time. The other issue, though, is when we look historically, inflation has often come in waves. So we are through the first wave. I think that's the conclusion we can take away from 2023. That doesn't mean we are done. That doesn't mean the Fed can say mission accomplished, because there could be another wave of inflation. And the small tick up in the year-on-year number is a reminder of that, but we don't want to overemphasize that at this time. I think what we want to say is the Fed now has a data point that they could use if they wanted to pause in September, if they wanted to get more data. That's on the table, and that seems like a very reasonable position at this point.
Right, and the headline number could continue to tick up over the coming months, if only because we're lapping the worst of the inflation from last summer. So those base effects are giving us a little bit less of a tailwind. But another piece of this that I think is really important. So this July CPI report, over 90% of headline CPI was accounted for by increases in shelter prices. We know that housing in the CPI acts with a big lag versus what's happening in the real economy. So I was wondering if you could kind of explain that relationship and how it might impact both inflation heading forward and how the Fed thinks about inflation, with imperfect data.
Yeah, it's a great question and an important technical issue when thinking about the consumer price index. So in the CPI, what we have are rent and owner's equivalent rent, not home prices. So there aren't asset prices in the CPI, whether stocks or bonds. And so we don't want the asset value of the house in the consumer price basket. We want the string of services of renting that house to yourself, whether that's through rent directly or an owner's equivalent rent type of calculation. And so this tends to be slow moving. So we're trying to account for all leases, not just new leases. We know new leases have slowed down over the past several months. And so that's going to filter through to the CPI calculation. In general, the CPI tends to lag home prices by about a year. And that's just a rule of thumb. It's not necessarily mechanical, but it works pretty well. And so when we have that type of situation, we can say over the next 12 months, because home prices have been coming down over the past year, we're likely to see the shelter component start to slow down. But the concern for the Fed would be, what if home prices start to bottom here? Because we've seen housing permits, some of the leading indicators like single unit permits, also some of the timely measures of home prices, whether that's the Case-Shiller data or the FHFA data, start to carve out a bottom. It's early to say that there's anything significant there, but we've had some early signs that something might be changing. So even if the shelter component of the CPI looks better for the next 12 months, we know that that's already information that the Fed has taken account of. This is one of the reasons why they've keyed in on core services X shelter as one of their items to look at carefully, and we look at that as well. So it's likely elevated, it's likely to slow down given what we've already seen in rents. The technical nature of the characterization will matter. But let's say home prices start to change direction, that's going to bother the Fed at a 12-month horizon when they try to think about what comes next year. So it's a complicated issue, it's multi-directional. We probably do see some relief over the next 12 months on a technical basis, but that's not really what we want to see. What we want to see is some better news fundamentally.
Right. And that obviously has a big impact on the broader economy as well. Speaking of, you all have had about a coin flip odds of recession over the next 12 months for a while now, especially as the Fed has continued to hike into restrictive territory. But you've also recently published a chart or a note titled What It Would Take for Us to Drop or Reduce the Odds of Our Recession Call. I'm curious if you could explain what that chart is and how it impacts your outlook for both the economy and for recession.
Yeah, absolutely, Ross. So this is basically about the labor market, right? So the big concern we have is that the labor market remains imbalanced. And as long as the labor market is imbalanced, the Fed's going to be agitated. So it's kind of like a forest that is dry. Any spark can start a fire, and that could be a big deal. When you have an overheating labor market as your fundamental characterization, any spark, any shock, whether that's from abroad, whether it's oil, whether it's commodities, whether it's food, that becomes dangerous. So we need labor supply and labor demand to balance, and we just don't have that yet. We're sizing the economy for something like 171 million workers, and we have a labor force, a labor supply number of 167 million workers. So we just don't have labor supply and labor demand balanced in a way that reassures us that we could absorb anything that comes our way. And that's why the odds of recession have to stay elevated, because the odds that the Fed might have to respond to something remains elevated.
Makes a lot of sense to me. Well, Don, thank you so much for the time. As always, really great insight, and hopefully we'll get to talk to you again soon.
Thanks a lot, Ross.